So here we are at the late stage panel, and what'll be interesting is to kind of compare and contrast what we've talked about here in the past 60 minutes or so with the other two panelists, the subtle nuances between the conversations you're going to be having in the early stage versus the growth stage, and then what does that mean now at the late stage. But before we kind of get further into the panel, if I could ask you to introduce yourself and your role and area of focus.
Okay. Well, my name is J.P. Noel. I've been in private equity since about 1997, part of two funds that invested about $500 million US, mostly in Southeast Asia. Part of our role was a bit to look at green tech at the time, since our investor included the Asian Development Bank and the IFC. So we had a special mandate to ensure that our invested companies were at least in compliance with environmental standards. Since then, I've been running my own firm. We're advising a number of family offices on investment opportunity. Clean tech is one of our focus.
I'm Rob Genieser. When I spoke here last year, somebody pointed out to me that I'm a three-continent guy, in that I started my career out here in Asia with Morgan Stanley up in Hong Kong. I went back to Harvard to get my MBA, and then I got sucked into Silicon Valley, a beautiful spot that I never thought I would leave. I worked there for Hamilton Quist for a number of years investing in tech, but I wanted to go to Europe because I thought Europe had a lot to offer back then. And I worked for Vertex there. I ran Vertex Europe for a number of years, and obviously was a frequent visitor back to Singapore in that capacity. One of the things that I always wanted to do is as one gets sort of later in one's career, you want to think about the next big trend, but you also want to give a little something back. And I thought that environmental investing would be pretty neat. And one of the things we haven't spoken very much about today is that when we look for deals, we're always thinking about what's the environmental impact that our company's going to have. And I think when we're thinking about late stage deals here, it's not enough just for the company to be late stage, but hopefully for some of the investors up here that these companies are also doing something good for the environment.
That's a great point. So maybe we can just start there, like we've done with the other panelists, and define a little bit by what late stage means in your particular organizations. Maybe there's different definitions, but for you, is there a specific metric or age or milestone that you look at that kind of pushes it into the late stage category?
Well, I think Peter's comments earlier were quite profound in that it's not enough just to find revenues. You have to find a working business model and think about where the market's going to go for the companies that you're backing. And let me give you an example of a complete and utter failure that I once was involved with. We invested in a company that was building next generation routers for the CLEC market. It had wonderful revenues. It had the prospects of being acquired by Cisco for a couple $1 billion. And of course, the CLEC market collapsed in 2001, and the company went bankrupt. So it was a great revenue story with a great potential acquirer. The only thing we forgot is that the market was volatile and eventually fell away. Another type of company back from the 90s, which was a success for all the wrong reasons, again, a late stage company that we invested in. It was an enterprise software play. It eventually got bought by IBM for a price that was lower than the price that we had paid. But the exciting bit was we had preference shares, and those preference shares accumulated a dividend over time, and we actually made a pretty decent return on that company. So, and one of the things I was just going to point out is that when we're looking at these deals, these companies, you always have to think about where is the market going to go, and you always have to think about what type of security you're getting. Sure, we all wish we could find great, fast-growing companies that will be bought by Google one day, but it's not quite so easy as that at the end of the day.
JP?
Yeah, I think late stage in our case, and more, obviously a proven business model with, I think, a diversified customer base, positive cash flow, which we want to see, a very clear use of proceeds. Expansion we want to finance. However, we pay, doing refinancing of bank debt is not something that we're comfortable with. Also, the nature of the business, if the company is running essentially a commodity business that is competing against what I call it at the end of the low carb diet, I think at the moment, with the fracking business, obviously, if you're just competing based on that basis, I don't find that very sustainable. The dependency, I think, was mentioned on government subsidies. This is a absolute no-go. especially if that involves the government giving you money. If the government is taxing carbon producing or polluting economies, and that's part of your model, I think that's a bit more acceptable. Quality of the team is obviously always a criteria, and I think that's been a bit difficult to find in Asia, given the nature of the industry is fairly new, and I think because it was created quite quickly and artificially with all the subsidies to basically a few sectors, solar, lithium batteries, electric car and whatnot, when those subsidies were removed, I think we've seen this business struggling quite mightily. So that's something that would stay away from.
No, it's very helpful. And being a three-continent guy, as you are, I'm curious to know if that definition changes by region. So, does late stage mean something different in Europe as it would be in Asia now, for example?
Absolutely. I mean, one of the things that's pretty apparent to me is that a lot of the investing that's being done in Asia is always called pre-IPO investing, i.e. we're going to find an exchange, we're going to float it, and we're going to get our money back, hopefully from the public investors showing an interest. If that's your model in Europe, you're going to have a broken model very quickly because there is no IPO market in Europe today. So when you're investing, you better be thinking about where's the strategic buyer, where's the corporate partner. And the closer you can get to those partners earlier on in your investment, the higher the likelihood of return is going to be. I think the other part about that, of course, is that you better sort of tailor your companies for the corporate buyer that can pay up. The guy that's either got the multiple or got the cash, who can deliver the return that you're going to need. Because it doesn't do you much good to sell a company at one-time sales to somebody if you're doing 20 million in revenue or something at the end of the day. So you got to find the guy that's willing to pay 5 or 10 times sales in a market where you can generate the type of return you're looking for.
Even on Asia, what we've seen in Hong Kong is even more pronounced than pre-IPO is the existence of cornerstone investors, which are the Li Ka-shing of the world. So if they endorse that business, then the local investor are more comfortable. And I think that's different than Europe, definitely.
The other thing I'd point out too is that when you don't have a very robust IPO market, I would also argue probably it's not quite as volatile as other parts of the world. When you're looking at the U.S. Type of investing, which I know well from my Valley days, it made a lot of sense to put a lot of money into highly capital-intensive companies that were benefiting from government subsidies if the public investor was willing to buy those companies on the exchange. And for a while there, they were buying those solar companies, those, call it wet clean tech companies. So that model was working. We can argue about whether it was doomed to fail or whether it was the financial crisis that brought it down. But, again, in Europe, you didn't have that capital. You didn't have those exchanges. So we couldn't have copied that model even if we'd wanted to.
So just changing gears a little bit, I think in the last session we talked about, what is it that, for the growth stage company that investor is going to bring to the party? Is it, strengthened management team, more robust corporate infrastructure, access to new distribution channels? How does that question play out for the late stage company? What is it that you're bringing to the party? Is it the exit? Is it necessarily capital? In addition to capital, what would it be? What does that conversation look like at this stage in the game?
Well, I think in Asia, definitely, the entrepreneur don't really like private equity investor coming in and talking about corporate governance and reporting and all of that in preparation for an IPO.
So what is it that you bring exactly? What do you do?
Annoyance. I think it's a preparation to IPO because there's limited trade sale in the market. So in order for the company to be prepared for an IPO, having a late stage investment to support that process is valuable. Also, I think there's been a shift in private equity investor from pure clean tech generalists to multinational company that now have venture arms. So if at the same time the private venture brings the boring reporting requirement, at the same time you co-invest with the Siemens that come and create name recognition, confirm the technology, and helps develop the business, then I think you can be quite well received by the companies.
I think it's all of the above in terms of your list. It depends on the company, it depends on their needs. I think maybe just a pitch here for stronger ties back to Asia and Singapore. One of the things we see in Europe is guys developing great companies, great technologies that are the #1 solution for Scandinavia, right? That's actually a big opportunity for us, because if we give them the growth capital, then we can figure out how to crack the rest of Europe, and then find partners in China or Southeast Asia or Singapore to bring those solutions to Asia. Because quite often the problems here are even more severe and more dramatic than what you see in Europe today. So if you can grow a nice 10 to 20 million business in Europe, the potential to grow a 50 to 100 million business by accessing Asia looks pretty exciting. So again, if you can offer that to your potential investee, that's a big, big opportunity. But again, everybody's got a different list. Just thinking down my 3 or 4 companies that I'm on the boards of, one guy needed a president of international. They'd never sold anything outside the UK. And they wanted to build a global business. So how do you find that guy? So we find him through our network. Another guy ultimately would like to have a bigger business in North America because he's built the #1 software company in France. And guess what? The big opportunity is to get it into North America, because that's where the big acquirers are. So again, it depends on the company in terms of what you can provide and offer. I think, by the way, the hardest part about late stage investing is to put yourself in the shoes of the entrepreneur. I saw about half a dozen hands go up. And when we asked how many entrepreneurs are here, how many companies, and I guarantee you every one of those guys thinks that company is their company today. When they bring in an investor, all of a sudden they have a partner. And you better be darn sure that you share their values, their views as to how you're going to grow that business, because otherwise it gets very, very difficult very quickly.
So shifting gears just a little bit again, and kind of putting a regional flavor on it, and an industry-specific flavor on it. We talk about late-stage investing, generally speaking, but what does it look like for the Asia clean tech market specifically? Is there such a thing as late-stage investing in Asia clean tech at the moment? It's such a kind of generally a new industry anyway. #1, #2, in some areas, for example, solar or battery, it was highly propped up by subsidy artificially. So, what are the flavors there?
Well, Asia is a big place, so it goes from Turkey to Australia, so I'm not sure I can cover all of it.
Start with the T's.
Yeah. Well, I think in the traditional businesses, I think the main play now is consolidation, be it in solar, batteries, electric car, and whatnot. And I think you'll see a very large fund starting being active in that. I think I've seen Arborvest recently launched a secondary fund just to take care of distressed asset in clean tech. Where it has been a bit of a neglect, I think, is the core industries where Asia excelled at. Asia is the factory of the world, but I don't think there's enough done in waste utilization in electronics, for example. I've been working with this company whose business model is to go collect electronic waste across the region, bring it, centralize it, dismantle it, because you have copper, rare earth metal, and whatnot, and recycled and sell that. And they've been growing at 30%, having very healthy margin, and they don't see much value added from me at the moment, but I can understand that. I think in agribusiness, you see also more and more, with all the food scandal in China, I think creating sustainable agribusiness model. We've been working on aquaculture system, which is purely contained, so that everything from the feed to the water that's getting used to the waste get used, recycled, and recontrolled and traceable. And I think that's this kind of industry that are more interesting to me. If you are able to lower the cost of doing business for some of those companies. And I think that some of your portfolio companies are focusing much more on that than creating the next new technology that will change the world.
Ron?
Yeah, I think there's a new type of company that is wanting to work with us. And that would be the traditional company that's gone to the banks looking for working capital financing and getting working capital financing in the past. What's happened in Europe is, the RBSs of the world, the Lloyds of the world, the Barclays of the world aren't making loans anymore to small companies. So if you're that successful entrepreneur that could get a working capital line from RBS, you're out of luck this week. So you got to come find guys like us. The other phenomena, I think, is that there's still this propensity to dress companies up as environmental or clean tech companies that frankly aren't. And I think I see some drift on the part of some other firms towards doing things that just frankly aren't environmental. But they do have cash flow, they do have EBITDA, and people are excited about that. So, I think you, again, have to be figuring out what your mission is, what you're supposed to be doing. But I think there are plenty of deals out there if you stay true to it.
One question, maybe compare Europe to Asia. Europe is a bit the leader in terms of clean tech regulation, I would say, and implementation.
We like our rules.
And do you think that leads to some industry displacement to Asia to an extent? And I think that the Asian company have the lower cost base to actually comply with some of the standards if they can be verified. I don't know if you see that happening.
I think I don't see that for a very simple reason is that let me speak with specifics, right? So one of our companies is a company called Enablon, and what they provide is the software that allows you to look at a supply chain to make sure that everybody in the supply chain is complying with quality, environmental, health, and safety regulations. And the reason it started in Europe is because, your point, Europe was the strictest and Europe was first. But now every corporation is buying the software, right? And why are they doing it? Because that CFO in the United States will go to jail if that factory burns down in Bangladesh and people get killed, right? So Walmart actually cares this week what's going on in those factories. So you can't push your problem like you could in the past. And so I think a lot of these factories are being brought into the global network and are forced to comply. What will be very interesting is the speed at which the large Asian corporates follow suit, right? So I'm sure Cisco has the software, but how long before Huawei has the software is the question. Maybe they'll build their own.
Yeah, I think Walmart, I've known that they gave suppliers until 2017 to meet the sustainability index or else they get kicked out of their supply chain.
So we got some of your, I think, strong picks for Asia. Rob, we didn't hear from you yet. Are there some kind of key areas, either from a megatrend perspective or a clean tech perspective, that are kind of on your near-term radar here in the next few years?
Well, I mean, maybe a comment about Asia or developing markets in general, although it's tough to describe Asia now as a developing market. I think it's well developed and past many others. But I think one thing that is definitely true is in Europe you see companies creating companies aware of what the European problems are, what the consumer wants there. I think it would be somewhat jingoistic to suggest that those problems are the same around the world. So I think that there are some great solutions that are being tailored to the market here that are going to be developed first here and then brought to Europe, for example. And that's what I'm looking up for. I'm looking to see some of those things
so you'll be
come
looking
from
at domestic, local domestic companies first?
something that's coming from east to west as opposed to west to east. And I think that will be a trend that you'll see over the next 5 to 10 years. In terms of the megatrends, we heard a long list of them on the past panel. I think the easiest thing to think about when you're investing is always go to where the money is, right? What I mean by that is that, who's got the multiples, who's got the cash? And I think the point was made earlier that it's some of these large IT companies like your Googles, your Facebooks, what have you, to the extent they start moving towards this market. I mean, Google already is making investments in wind farms, for example. Maybe we should try to benefit from that and try to tailor our companies so that we can work more closely with those guys that have the multiples and the money.
I also think it's important for Asian companies to remain very well abreast of environmental requirements that are imposed in the EU, the US, or Canada, because once they're imposed, they're going to stay for a long, long time, and it will be impossible to export to these markets.
But it's interesting, and it actually is more interesting perhaps to ask the folks in the audience. When I see exploding watermelons in China or pigs in the river, you don't need an EU regulator to tell you that's a bad idea. And I think that the local sort of demands either put on these companies by the people or the governments is going to grow over time.
So maybe we'll just pause. We have just a few moments left. Any questions for the panel specific to late stage?
The question that I have is the exit. When is the right timing? What is the metrics that you look into? I think you have mentioned lightly. Specifically, is it the number of years that you set yourself, or is it the multiple that you look into? Is it the capital requirement that you need for the next development? What are the key things? Because this is, I think, one of the riskiest part of any investment return, because if you get it wrong, the timing, I mean, basically all the investment that you made can wash away. So how do you look into it?
There's an element of luck involved, obviously. But I think if the money is properly deployed and the company reached its numbers, most fund managers and their LP are typically quite patient in terms of realizing the investment, because I think everybody's quite aware of the fluctuation of the market. Most of the fund have extension period that can be up to 2 more years, a bit less nowadays. So I think you can, to an extent, manage that process a little bit, in my view.
I think it's important on your team as a venture capitalist to have different backgrounds on the team that look at the opportunities from different perspectives. So I'm the people guy on our team. I like to size up the management, just make sure that they can take it to the next level. And if not, how do we add to that? The guy who would be sitting here was the technology guy. He made antennas in his day, and he loves the geeky stuff, right? And he will stare at the patents. He will stare to make sure that we have a sustainable competitive advantage over time that won't erode as competition comes up. And the third guy, I don't know where GE is going, but is an ex-GE guy, and he loves to stare at cash flows, right? And making sure that this business model is going to work over time and be profitable. And so to have these different disciplines in the team forces you to think about all the different aspects that you need to get right within a company. So I think that, again, when you're looking at an investment too, you want to think about what type of portfolio you're trying to construct. And so, for example, in our portfolio one, we have 2 to 3 companies that are disruptive technologies. I wasn't doing science experiments because there are some corporations that are co-invested alongside of me in these things. So I'm pretty confident the stuff works, and it's just a question of scaling. But that was one type of company that we had in there. If I'd done just that would have been a very high-risk approach to building a portfolio. The second type of company that we put in there were companies that were sort of the last round before this stuff really took off in terms of a licensing model. And so this was the last chance to invest before the stuff started to go global. And then the last bit, which is probably the majority of the portfolio, was just growth capital. So these were companies that were working in a region, and then we had to figure out how to build it out across the globe.
I can give you another example of our investment we made. I don't think I was born then, but on my previous firm, the investment was kept for 30 years as part of the portfolio and was sold for $2.5 billion a couple of years ago for an IRR of 30% over that period of time. So if there's a business case, it's definitely defensible that a fund can keep it for that long.
But maybe just to ask the question a bit further, take it the next step, it sounds like there aren't predetermined milestones or triggers in which an event would occur, that it's very much depends on the state of the business, depends on the market, depends on...
Well, you keep your eyes on the stock market, obviously, if that's your exit, of course. But then the time you have to take to prepare for IPO,
but there's
you don't know what's going to happen.
There's no number that's set, a year in advance. It's, all right, if we
Well,
hit
typically
this,
you have a target.
we're
Typically
pulling
you
the
have a
trigger.
target. Typically you have a target return.
Right.
So you review the investment on a regular basis.
Okay.
If you're happy with your return, you're happy with your return. Some fund use derivative now to protect. Once the company is listed and they still have a stake in it, use derivative put option to keep at least the return. So.
Rob, any final thoughts?
Well, I think that's a very interesting question, is how people choose to exit and why. Certainly, there are a few people that sell companies just to raise the next fund.
That was the question, yeah.
I think that there is always the pressure to deliver returns to investors, and you have to understand, just like earlier I made the point, you have to understand what the entrepreneur wants, you have to understand what your LPs want. And to suggest that one should be doing something different than what your LPs want is probably not the right strategy for a long-term sustainable business model.